Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Just over 6 weeks ago, we looked at the prospects for equities as we started Q1 2021 earnings season. And now it's time to look back over those earnings to see what we can learn from them and what the data and the market's reaction can tell us about how equity markets will behave as we enter the summer months. First of all, let's look at some numbers. With the vast majority of S&P 500 constituents now having reported Q1 2021 earnings, we find that 86% of those stocks have reported a positive earnings surprise, whilst 76% reported a beat in revenues. As a result, the S&P 500 is on course for its highest number of positive earnings surprises since 2008. And the level of those earnings beats, which came in at plus 22.5%, smashed the 5-year average of just plus 6.9%. Earnings growth for the top 500 stocks in the country is likely to come in around plus 51.9% for the quarter, and if that is the final figure, it will be the biggest percentage rise since Q1 2010. What's more, 10 out of 11 S&P sectors posted earnings growth in Q1, with only industrials posting a decline. The consumer discretionary sector posted earnings growth of plus 231%, and the sector also had the biggest beats, with earnings exceeding analysts' forecast by a whopping plus 57.3%. Though, in terms of the widest breadth of earnings beats, we need to look elsewhere. 94% of stocks in the information technology sector and 88% of those in communications services beat their earnings forecasts. In terms of the market reaction, stocks that beat earnings rose by an average of plus 1.2% over the 2 days either side of their numbers, whilst stocks that reported an earnings miss were marked down by minus 0.9% over that 4-day period. The 5 years averages for those metrics are plus 0.8% and minus 2.5%. That shows us that the market reacted positively to good news and took any bad news very much in its stride. Overall, the S&P 500 index is around plus 3%, higher than it was just ahead of Q1 earnings seasons. Perhaps the only fly in the ointment for Q1 earnings was the relative lack of guidance offered by companies for Q2. Of those that did offer guidance, 33 companies were negative on their earnings outlook, whilst 54 had a positive outlook for the current quarter. In terms of valuation, the 12-month forward price earnings, or PE ratio for the index, is 21.2 times, which is well ahead of the 5- and 10-year averages of 18 and 16 times respectively. Those premiums suggest that investors believe that U.S. blue chips will continue to beat Wall Street forecasts over the coming quarters. However, not everybody is in agreement with that stance. Morgan Stanley recently published a strategy note on U.S. equities that suggested a minus 10 to minus 20% decline in the PE ratios for the S&P 500 were warranted, simply because the economy was in what it termed a mid-cycle transition, in which rates of change in both growth and monetary policy have peaked, and higher taxes levied by central government and the tapering of asset purchases by the central bank would effectively take the wind of the market's sails, and that a combination of rising input costs and slowing growth should push valuation multiples lower. The investment bank also talked about a tug-of-war developing between earnings and valuations, which have up until now been pulling in the same direction. Morgan Stanley first suggested that we would see this kind of mid-cycle correction back in November 2020, and despite the fact that it is yet to materialize, their U.S. equity strategy team hasn't changed its mind. Morgan Stanley isn't saying get out of equities completely, however. Rather, it's suggesting repositioning so as to prepare for this mid-cycle bump in the road, which they liken to the period after World War II from an economic and monetary policy standpoint. With that in mind, they recommend financials that will benefit from rises in interest rates, materials that stand to benefit from rising commodity prices and demand created by spending on infrastructure. They favor consumer staples over consumer discretionary stocks, which suggests that U.S. consumers may tighten their belts once normality is restored. And finally, they suggest reasonably priced growth in quality stocks, which they say can be found within healthcare and certain parts of the communications services sector, which they prefer to tech. This defensive positioning is justified, they say, because risks in equity markets will shortly start to outweigh rewards. For example, when PPI, or factory gate inflation, is running higher than CPI, the Consumer Price Index, then profit margins come under pressure, as under these conditions, manufacturers and service providers can't easily pass on rising costs to the end consumer. As this chart shows us, PPI looks to be starting to outrun CPI in 2021. The consumer, of course, accounts for as much as 70% of GDP in the modern U.S. economy, so their behavior and spending patterns carry a lot of weight. However, one factor that perhaps Morgan Stanley hasn't considered is that the S&P 500 stocks, which generate less than 50% of their sales in the U.S., grew their Q1 revenues almost twice as fast as those companies that are focused solely on the domestic market. The stocks that grew their revenues the quickest were those that had more than 50% of their sales coming from overseas, and at least 25% of their total revenues coming from the Asia-Pacific region. These stocks grew their revenues in Q1 by an average of 21.6%, more than twice the rate for the index as a whole, which stands at 10.7%. The inference here is that S&P 500 stocks that look outside the USA for their living could offer faster growth and an attractive hedge against any slowdown in the domestic economy. According to Trackstar IQ, our proprietary search tracking tool, both QQQ and SPY are back as the most viewed ETF tickers by institutional investors, suggesting that the street believes that the S&P 500 has more upside to run. That's all we have time for this week, but as usual, make sure you do your due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.